Negative cues, but we have good gains under our belt. So let's see if the dips get bought. The first tick on the index is a loss of about 90 odd points, so not looking good. That's on the Nifty. On the Sensex is down almost 500 points. So straight off the back, it's a fall of around 0.6%. Dragged, of course, by Infosys, down about 10%. But Tech Mahindra is the other one. As Rima was telling us, there's this telecom exposure, and post Infosys and TCS numbers and the read-through there, Tech Mahindra could also report weak numbers and hence down 6.5%. HCL Tech, Wipro, TCS are all down about 2 to 3.5%. So the IT pack is under pressure. Interestingly, HDFC Bank is also dragging its feet, so it's not contributing or not preventing the fall. HDFC Bank now down about 0.8% post its numbers. A decent set of numbers, but as I said, some niggling worry over there. So down about 0.7%. SBI, Divi's Labs, Hero MotoCorp, a couple of other stocks that are in the red. On the upside, though, you have auto names that are not doing too badly. Eicher Motors is up about 1.5%. There was that Goldman Sachs upgrade last week. Dr. Reddy's, you have Kotak Mahindra Bank, Apollo Hospitals, Reliance Industries is holding up, comes out with its numbers on Friday. Then there is Axis Bank, ICICI Bank ahead of numbers on Saturday, that's holding up in the green. IndusInd Bank and Coal India are a couple of other stocks that are in the green. The Bank Nifty is the one that's batting for the bulls right now, up about 30 odd points. But stripped of that, it is a very weak market. In fact, now getting worse as we speak, 130 points gone, and primarily led by the IT names.
Well, that's right, Sonia, and it's bang in the slot actually. 17,700, 17,730. That's the options data indicator as well as the recent low that we saw on Thursday itself, 17,730. We've broken that range in the first 5 minutes itself, so let's see whether or not there is some buying that creeps in there. Focusing on a few stocks, though, from the broader markets, mid-cap IT is getting smacked in the face, actually, as we speak. You have Coforge that's down 6%, L&T Tech Services, Emphasis, Birlasoft. From the F&O names, they are the top losers, all of them down between 3 to around 6% odd. Some green is what we're seeing on a couple of banking names. RBL Bank is doing a relative outperformance, and Chola Investments as well is trading mildly in the green. A couple of other names that should be in focus is GTPL Hathway. They reported a loss. The margins as well slipped close to around 600 basis points. So GTPL Hathway should be a stock that should be on radar, down close to around 8% on the back of weak numbers. You have a couple of other notable names as well. Camden Fine, there was an open offer that was launched. It was announced earlier today. So that stock should be in focus. Let's get it up for you on the screen. Camden Fine. That one, in fact, is up close to around 2.8%. Open offer coming in at around 160 rupees odd. If it's successful, the promoter entity's holding goes around 55% odd. Landmark as well, they came out with an update earlier today. Landmark Cars, earlier this morning. That's what they updated on the exchanges itself. So that stock as well will be reacting to their operational update. Well, we're not seeing any buying as of yet as well. We currently trade below that 17,700. It's a test for the bulls. The buy on dips thesis will be tested today. Prashant.
It's quite incredible, Nigel, that, I'm just looking at the top list of volume-led losers, and it's IT, and more IT, right? I mean, Infi, of course, top of the list. I mean, if we can quickly have these intradays for you, 10%. TCS is down 3.5%. Then you have HCL Tech, which is down, 3.7, 3.8%. LTIM was down 10%. It's recovering a little bit, down 8%. That is LT Mindtree. Tech Mahindra is down a full 7%. Persistent is down 8%. Wipro is down 4%. Coforge is down 6%. Emphasis is down 6%. Info Edge, Naukri is down about 6%. LTTS is down 5%. Sonata Software is down 3%. I mean, there is not even a break for something non-IT to be in the list. It's just completely populated, packed with IT names which are down anything between 5 and 10% in that particular list. So that's where volumes are on the downside as well. Just a few other names. Power Grid is up 2%. It's the top volume-led gainer across the board coming up. So that's just 1.7 higher. Adani Green is up about 1.8%, again from the power space. IOL Chemicals is up 7%, 382 on IOL. So again, I'm just mentioning these because they have volumes at this point. TV18 Broadcast is up 4%. Stocks at about, 31, 32 right now. What else? Venus Pipes was a big mover. I think there was a large individual investor who bought into Venus Pipes. Was moved on Thursday. It's up another 8% this morning, 923 on Venus Pipes. Tanla Solutions is up 3%. Just Dial is up about 1.7% or so. and then kind of volumes completely drop off, so I won't go into that list. Market breadth is negative, 1,040 lower, and about 840 stocks are higher at this point in time. 17,670 is where we are at in the Nifty, about 160 odd points lower is what we have. So lots of stuff moving around. Manishi Ray Chaudhary is Asian equity strategist, equity cash, Asia Pacific at BNP Paribas. He's joining us right now to take some questions. Manishi, good to have you with us here. Thanks very much. I mean, it's very unlikely that if the market is in strong hands, I'm not sure if the market is in strong hands, but we've seen a big 1,000-point nice rally on the Nifty, that one earnings set will completely break the momentum permanently. If it was, in any case, a little fragile and most of it was driven by short covering and pullbacks were due, that's a different case. I just wanted to get your thoughts. How are you looking at the market with what we've seen with Infosys and the disproportionate impact it is having across the IT board?
The initial round of results in the Indian market have been disappointing. In fact, not only in the tech majors, but also in some of the large private sector banks. So it's, I think, no surprise that the market in the short term is underperforming and will possibly continue to underperform its Asian peers, going forward. And that is one of the reasons why in our most recent Asian model portfolio reshuffling, we did not upgrade India to an overweight. We still retain a neutral stance, despite the fact that Indian relative valuations have actually declined quite a bit. If you compare to MSCI Asia ex Japan, they were at more than 2 standard deviations higher compared to the long-term average. They have now come down to somewhere close to 1 standard deviation higher. But we think there's some more way to go. Maybe over the next 1 quarter or so, India will continue to underperform. And it's only in the second half of this year that we would have to take a closer look at this market.
Okay, all right, got that. So a bit cautious over there. Markets will continue to underperform its Asian peers and you retain your neutral stance on India. Manishi, hi, good morning. What do you do with IT? The problem here is that there is lack of clarity in terms of what the earnings visibility could look like, and uncertainty is something that the market doesn't take very well. Do you think that there is further derating despite the fall that we've already seen?
At least over the next 1 quarter or so, I would expect, this wobbly movement that we are seeing to continue. Further derating, to borrow your phrase, and investors would have to be very selective in terms of, which stocks in the sector they invest in. There have been sort of, what should I say? What's the right word here? Unprecedented or, unexpected ramp downs by clients, as we have seen in some of the IT biggies results. And, and that's not really good news as far as visibility about earnings are concerned. It's only over the next 1 or 2 quarters when we get to hear more about the deal wins of the IT companies that we would have some more certainty. But in the near term, if someone has a short-term horizon, short-term outlook on the Indian market, it's possibly better to stay underweight on the sector.
All right, better to stay underweight on IT. But with a short-term view, you said, right? What does a longer-term investor do? Because, some of these IT stocks, are not only widely held in funds and in portfolios, but they're retail investor favorites as well. And a lot of them have been keeping the faith up until now. Is it time to churn out even for longer-term investors? What's the approach?
If one has a 2 to 3 year time frame, then we do like the IT companies for a couple of reasons. Despite the concern about recession in the United States, we are seeing relatively strong deal wins from the IT companies pretty much across the sectors, BFSI, retailing, other engineering. And that would obviously stand them in good stead over the longer term. Second, we are also seeing wage rationalization, some degree of the wage pressure that they faced, which led to, the sort of outsourcing of some of the services that they had to do, and that led to margin compression. And that was the story in 2022. I think those wage pressures are likely to subside going forward. It'll take some time, no doubt, but most of the IT large frontline companies are moving in that direction. So, if someone has a 2 to 3 year time frame, I would certainly, think of focusing on the large frontline IT service companies. But, one has to keep in mind that the near term might continue to be wobbly.
All right. Hi, Manishi. Good morning. Manishi, what about the auto space? I recall you had lightened some positions, I think, towards the end of 2022 or the start of 2023. How are you all positioned on the auto space? And if you could further drill it down into two-wheelers or, tractor space, what do you like still?
Absolutely. And you're right in recalling that we had lightened our positions in the auto space in late 2022 on early December when we downgraded India to a neutral from an overweight stance. Autos was one of the sectors that we lightened our positions in, and we actually continue to maintain that stance. We still prefer the four-wheelers, the passenger vehicles, compared to the two-wheelers. We have no position in the two-wheelers right now. And even within the four-wheelers, we are looking at possibly the market leaders in passenger cars or SUVs, the kind of companies who have pricing power and therefore are able to maintain or enhance their margins and, cater to a much larger volume of customers than their competitors would be. So here again, it's basically a question of being very selective, looking at the cash generators, looking at the excess return generators, which almost certainly would be the market leaders.
All right, just, Manish, just coming back to you, you need to take a look at the markets. We have moved to the low point of the day. Tech was as still struggling. The problem is the HDFC twins. Now, both of them are trading with a cut of around 1% to around 1.5%. And that's a little bit worrying because that's a large weight on the index that's moving lower. So the Nifty Bank from being higher with a gain of around 150 to 200 points odd, because the HDFC Bank has done a bit of a U-turn, that's why, in fact, now we have gone ahead and we have broken that 17,700 odd mark. You'll want the 17,650 to around 17,700 level to hold out. Our technical experts as well told us earlier today. So if that breaks decisively, then you're in for a bit of a near-term pullback is the sense that we're getting.
Exactly at the level
Yes.
which needs to be held, 17,650. This is, at least I saw that 100-point low start. There was, after 100, there was another 100 to go. I didn't think it'll come so soon. And that was what I was saying in the morning as well. But we are there. Let's see if the level is defended or not. But, the HDFC Bank is also something which is not helping. And again, a point that I was making in the morning earlier as well. IT, of course, is well understood. It would have been a big one, but HDFC Bank also no real help with what it is doing. Manishi, what else in a market like this? And any interesting kind of sort of new global views which your team is kind of putting out, which is implications, anything radically different from what is consensus? Actually, I don't think there is a consensus right now because there are many who believe that there's unlikely to be a recession. It'll all be very smooth into the end of the year. And there are those who believe that there will be. Later in the year, it's inevitable now. The damage has already been done. Your sense?
So, I think on recession, we're somewhere in the middle of the road. We think that the United States would possibly be stepping into a recession, a very shallow recession nonetheless, maybe from Q3 of this year. So Q3 23, Q4 23, and Q1 24. This is the period to watch out for, as far as the technical recession is concerned. We are also believers in a Fed rate peaking out, sometime in May. So as we call it, one more and done. 25 basis points hike in May and the Fed would be done. But we're not subscribers to another opinion that's been emerging, particularly from the US bond market. If you look at the implied rates, it seems that the US bond market is implying a rate cut of about 50 basis points in the second half of this year. We are not quite subscribers to that idea. We think the rates pretty much would stay where they are at 5.25% for the rest of the year, and any rate cut would be relegated to 2024. it's like these variables in terms of the non-farm payrolls or, the trajectory of core inflation, core services inflation in particular, that'll have to be watched very carefully over the next 1 or 2 quarters.
Okay. By the way, Infosys is falling some more now. Over 1.5 crore shares have already been traded on the downside, and that's not a good sign. So it's not only price action, but there's volume action as well on the downside. 12% lower now on Infosys, Tech Mahindra, HCL Tech, Wipro, TCS, all of them dragging the markets further. Just before we let you go, Manishi, wanted your thoughts on how you see this overall market picture shape up. I know you started by saying that you are a bit cautious on the market now, but do you think that there could be a longer time correction, or are you staring at a price correction as well, where we resume, the lows that we saw in the early part of this year?
Well, a price correction seems to have commenced, with this, with this disappointing start to the Q4 earnings season. I wouldn't be surprised if a price correction accompanies a time correction. So it's difficult to quantify exactly how much that near-term price correction might be. But over the next 1 or 2 quarters, I would expect India to experience both. Maybe a small time correction combined with a time correction, so that we come back to that old, close to about the 40% premium to the Asia ex-Japan multiples, which has been a long-term average. So I think it's basically two variables that we tend to watch: earnings estimates, how they pan out, and currencies. And I think on the currency front, the Asian currencies are getting a bit safer now, with Fed rates likely peaking out. But the earnings environment we will have to continue to watch that very, very keenly.
Okay. Manishi, thanks a lot for stopping by and speaking to CNBC TV18. Appreciate your thoughts. So that's a cautious view on the market. The market, by the way, is still under quite a bit of pressure. In fact, this is the first serious fall we've seen in a while, actually. The last 10 days have been pretty good for the market, but we're undoing a lot of the good work in just the last 1 hour, 20 minutes or so. But let's talk about what's happening with the AMCs. Equity mutual fund inflows hit a 1-year high in the month of March. The SIP inflows also remained rock steady and reached a 1-year high of about 20,000 crore rupees. To discuss this and more, we are joined by Radhika Gupta, the Managing Director and Chief Executive Officer at Edelweiss Asset Management. Nilesh Shah, the Managing Director at Kotak Mahindra Asset Management, is joining in as well. And of course, we will be talking about a lot of the developments that have happened on the regulatory side and whether that will, impact the AUMs going forward. There were a lot of changes that were announced in the budget too. Lady and gentlemen, thanks a lot for joining in. Radhika, first, I want you to come in on this. There were a lot of regulatory changes that have taken place in the budget, and the fear is that this will hit the total expense ratio, and eventually the AUM growth, the yields as well could suffer. Tell us a little bit about your version of how this could play out for the industry.
So, Sonia, if you are referring to the conversation that SEBI put out on the review of total expense ratio, then I think, while that conversation is yet to conclude and we're yet to see the outcome, I think over the last 10 years, the mutual fund industry has seen a lot of regulatory changes. Recall there was a TER cut in 2018. We've had a change in upfront commissions. A lot of things have happened. And while margins may have come under pressure as asset management companies, I think volume growth has compensated. So finally, net, asset management companies, the numbers speak for themselves. It's a 40 lakh crore industry. So I truly believe that while margins can come under pressure, volume growth will compensate for it. And we still are in a country where under penetration levels are so prevalent that the growth room for AMCs is substantial. The second change, I think perhaps that you're alluding to, of course, is the whole change around fixed income taxation. And as far as that is concerned, I think it is wait and watch for the next 3 months. I know a lot of people have been saying, oh, FDs are now far more attractive. Yes, certainly debt mutual funds are, the tax alpha also, is gone. But I don't think the story is so simple. I mean, we are the largest player in the target maturity fund fixed income market. And I still think there's a lot that the open-ended debt mutual fund has to offer that traditional instruments don't have by way of liquidity structure, longer term options. I mean, you don't have 10-year FDs in the market. So I think it's
Sure.
wait and watch. Consumers react.
Radhika, just one follow-up. You said margins could come under pressure. I mean, because of what's happening with the regulatory changes, right? I mean, the total expense ratio now will include GST, brokerage, STT. There's a uniform total expense ratio across schemes. So can you quantify for us what would the margin pressure be? Because there was a brokerage report, BOFA actually downgraded a lot of the AMCs, saying that there's significant amount of pressure expected. Could you quantify it for us?
I think it's too early to speak to that because all this is conversation until something concrete on TER comes out. For instance, if brokerage and GST were to be included, and I'm saying this is just a conversation, perhaps total expense ratio might be increased just a little bit to make up for that. So I think everybody is cautious of the fact that there are listed AMCs, who have meaningful market cap, and any action will be thought through. So I think it is a little early to quantify exactly what the impact on margin pressure will be because the rules are not out, and I know a lot of discussions are happening.
Radhika and Nilesh, great to have both of you here. Thanks very much. Nilesh, if I can come to you on this total expense ratio, and not from your firm's point of view, but from an industry point of view, if you just step back, because this will have implications, right? If brokerage, etc., is included within the total expense ratio, I'm sure AMCs will pass some of this on to to the sell side in terms of lower brokerage paid. That has then cascading effect in terms of the quality of research, service, the coverage of stocks. Just talk us through. I mean, the implications of if something like this were to actually happen. Because as Radhika said, while it has not happened, what we heard from the SEBI chief, it seemed like they were very keen that this should be the path going forward. Your sense, Nilesh?
SEBI's processes of consultation, as industry, we have shared our feedback. We hope and pray that the feedback will be considered while formulating a policy. At the end of the day, we will have to follow what the regulation is. As business, we will definitely try to optimize our cost, share our burden with partners. But at the end of the day, do remember that there are three models in industry. One model is new pension scheme, where dice is loaded in favor of investors with very, very low operating expenses. And the manufacturer or the distributor does not get rewarded for their efforts. Despite giving tax incentives, the total AUM in NPS is less than 60,000 crore from non-committed subscribers like government employees. The other side of the model is insurance, where dice is loaded in favor of distributor and manufacturer, and investors have to bear higher cost. We believe mutual fund is the right model, where dice is equally in favor of distributor, manufacturer, and investor. We believe in SEBI as our regulator will do everything to expand mutual fund industry and support its growth so that we can continue to provide financial freedom to every Indian.
But that's very well explained, Nilesh. Could you tell us, Nilesh, I mean, so on an average, what is the brokerage that you pay at this right now?
So the brokerage which is paid to sell side is regulated under SEBI regulation. There is a cap of about 10 to 12 basis point on a cash trade. And on the derivatives trade, it's even lower. So effectively, the domestic brokerage or sell side brokerage receive a very, very restricted amount.
Correct. So if this 10-12 paise is included into the TER, I mean, could you tell us what could be the implications for profitability? Or this, as you said, you began by saying some of it will be split in terms of you'll pass some of this on in terms of lower commissions, etc. But broadly, what kind of numbers are we looking at, Nilesh? Is there a way to assess at this point?
Prashant, we will cross the bridge when it comes. As of today, we really haven't done calculation in terms of what will be the brokerage outflows, what will be impact on TER, because this is part of a fairly broad reform package. This is just one element of what's probably expected to come. So once it comes, we'll have a look at it and do a fair division. There will be benefits for investors undoubtedly. There will be cost sharing between manufacturer, distributor, and also sell-side brokerages. But my limited request is, please remember, if we go towards NPS side, where everything is loaded in favor of investors, there will be sacrifice of growth. And again, I repeat, only 60,000 crore AUM is there in NPS from non-committed investors, despite giving handsome tax benefits. You get about 3% tax savings if you subscribe to NPS from your employer's side. This is the highest tax incentives ever offered in India, and yet you have only 60,000 crore after more than 1.5 decades. On the other side, we know when the dice is loaded in favor of manufacturer and distributor, the investors' interests are shortchanged. Mutual fund industry has balanced between cost and benefit. It has shared equally the pie between manufacturer, distributor, and investor.
Sure. Got it. All right, just one final question, Radhika, to you. You were talking about the debt funds, right? With this recent withdrawal of indexation benefits, how do you see the flows into debt funds get impacted over the next, say, year or so?
So I break this into two parts. One is, under 3 years, where anyway there was no impact of taxation. So I think there your liquid overnight short-term funds, will continue to be business as usual. I think a category of funds called arbitrage funds, which was popular with corporate and HNI investors, it's fixed income like in structure, but still has equity taxation, will continue to be more popular. In fact, perhaps more popular than it has been in the past. Over the 3-year category, where the tax benefit is, has some impact, I genuinely think it is wait and watch. As you know, AMCs, of course, got large flows in March before the tax change happened. And I think customers have parked a large part of their asset allocation, at least for the last couple of months, through the months of March. Now it is wait and watch. And I repeat, I don't think that, the answer is so black and white. For instance, in an FD, you don't have longer term options. You have to pay tax every year. In a mutual fund, finally, you pay the tax on redemption. So there are still a lot of benefits to mutual funds. And I think liquidity is a huge benefit. I think consumers will choose the option. I also think one category of funds that will get more popular is hybrid funds. Rather than doing equity and debt standalone, you can do it in the context of a hybrid fund, like a balanced fund or a balanced advantage fund, and enjoy equity tax benefits. So I think hybrid funds will become a more popular way for the retail customer to do asset allocation, and that's something the industry has very strongly advocated.
All right. Thanks so much, Radhika, as well as Nilesh, for stopping by and discussing this topic. We look forward to further clarity, and we'll have a chat in the coming months as well. Well, let's move on then. The government has amended the domestic pricing model of natural gas in line with the recommendations of the Kirit Parikh Committee. That's with regard to gas pricing. To discuss the impact of this new gas pricing regime, we are joined by Mr. Ashu Shingal, the CMD at MGL, that's Mahanagar Gas Limited, who joins us. Hi, Ashu. Good morning. Thanks so much for joining in. Well, this long-awaited move has come about, and we have already got the notifications that you all have trimmed down on the pricing. That clearly would lead to more focus on the volumes. So what kind of volumes are you all factoring in for the coming year? That's for FY24 as well as FY25. And also in FY25, that Unison acquisition that you all did will be contributing. So how much do you expect it to contribute?
Good morning, everybody. Yeah, the Kirit Parikh Committee has been a good move by the Government of India and it's a big relief for the CGDs because the prices have been hovering around 8.5, and that would have gone up to more than $10 per MMBTU had this report was not implemented. Now, coming to the volumes which you asked, then already, as you know, we have passed on the benefit. Around 8 rupees reduction has happened to the CNG and 5 rupees per SCM in the PNG. And similar reductions have been done by other CGD companies, varying from 5 rupees per kg to 8 rupees per kg. So MGL have been one of the highest of 8 rupees per kg of CNG. Besides 2.5 rupees per kg of CNG benefit we have passed from 1st February. Now, coming to the volumes, there are two things to it. One, that 21-22 and 22-23, we have already gone up by 15 to 17% from around 3.1 MMSCMD to 3.5 MMSCMD. So we expect, because of these positive changes, we expect another 5 to 7% growth on every year-on-year basis by several moves which we are taking. And unison-wise, current the volumes are very low, but we expect that it will grow with time.
All right, so 5 to 7% volume growth you're seeing for FY24, and then 5 to 7% growth for FY25 as well, in terms of volumes.
That's very true, but it's subject to so many other things which are beyond our control, like the prices of diesel and petrol and so many other things.
Got it. All right. For the time being, it's working in your favor. What about the EBITDA per unit? I'm reading a Jefferies note, and they're saying that they're expecting it to move up as well, to around 10.5 odd from around 9. What kind of a number should we work with for FY24 and FY25? Things can change and things are dynamic in nature. But for the time being, we have a volume outlook. What about EBITDA per unit?
See, the benefit of Kirit Parikh has been passed on straight away. I mean, whatever the $2 per MMBTU rates were reduced, we have passed on to the consumers. So EBITDA per unit should be remaining in the same numbers, and it may slightly get better off if the domestic prices or the LNG prices are reduced, because EBITDA is also dependent on PNG as well as the industrial and commercial customers, which we take LNG and supply it to the customers. So we expect that it will be in the same range. Maybe Jeffrey is right. Maybe 10 rupees per unit should be a comfortable thing.
Okay, 10 rupees per unit is what you're expecting. That's for FY24, is it?
Yes, both this year and the current next year.
Okay, 10 rupees per unit. That is higher than what you've done in the recent past, right? So there is a growth that you're expecting. Are you also looking at a volume growth for FY24? And if yes, what would it be, Mr. Shingal?
Yeah, I just answered that.
5 to 7% for FY24. Got that. Okay. I want to also understand, since there is a volume growth of 5 to 7%, there's an EBITDA growth that you're looking at as well. Any expansion plans that you have in the near future? What is the cash on the books and how much of it would be used for expansion?
Currently, we have 1,500 to 1,600 CR in the balance sheet, and part of it will be used for Unison acquisition, which is expected to take place somewhere in October or November, post PNGRB clearance. Other things we are exploring. There are several initiatives which we are planning or exploring and trying to scout for new opportunities. And as and when they fructify, we will intimate to the market. But definitely, we are running our strategy also and thinking about various areas where we can expand the business.
All right. So I also wanted, what is your current sourcing mix? I have a dated number that's for FY22. Well, APM gas accounted for around 86% odd. Currently, what is the mix? If you could give us the breakdown.
Yeah, you are right. Currently, also 85% is the APM mix. Balance is coming from mainly term LNG, which we have Henry Hub, and we have other sources like Reliance we are taking, HPHT we are taking. So all the 15% is coming from a mix of almost Henry Hub is, we can say 5 to 6% is Henry Hub. Balance is Reliance and Spot.
You said that you're exploring several initiatives with this 1,600 crores that you have on your books. Of course, part of it will be used for the Unison acquisition as well. But which are the other areas where you can expand the business, and anything that you're looking to do in terms of acquisitions in this calendar year itself?
I don't think acquisitions in terms of CGD will be feasible this calendar year, because acquisition takes a lot of time, and this acquisition has also fructified after 7 to 8 months of very deep due diligence. The other areas we are exploring is some small minor equity in electric vehicles value chain, or some manufacturing, or some CBG or ethanol, or so many other areas like long-term LNG haulage. So the slate is open, like whatever the company can do with the limited resources we have. And also it should have some synchronization with what we are already doing.
All right, we'll leave it there, Mr. Singhal. Appreciate you joining in, and good speaking with you, as always, here on CNBC TV18. I mean, we're down a full 200 points, 17,630. I mean, incrementally, things have not gotten worse. Maybe on the market breadth side, just a little bit, a tad bit. 1140 stocks are lower, 920 stocks are higher. That's the advances to declines ratio. We'll come back with our special segment, Quarter Se Quarter Tak. Mangalam will tell you all about what the expectation from the FMCG space is. And then Abneesh Roy of Nuvama Institutional Equities will join in to discuss some of the companies, FMCG companies, and how he is positioned. Stay tuned.